Hi, I'm Jimmy. In this video, we're looking at the artificial intelligence bubble, if we think that there is one. There is. It looks like there's a bubble. But I found some interesting correlations. So, in the most recent video that I did, where I talk about some of the deals that are happening, after I finished that video, I was looking through some of the research I had done and I realized, man, some of this stuff is real close to what happened both in the tech bubble and interestingly, also in the 2008 financial crisis. There's some striking similarities between what's happening right now and what happened back then in both of those situations where things eventually blew up. So, just to lay the basic groundwork, then I'll walk you through the two scenarios that are happening right now that could potentially become a problem. So, the first scenario, or the first, let's say, to set up the groundwork. So, according to different studies that have been done, now this isn't all that precise because not every company publishes exactly what they're spending on AI. But the estimates are over the past 2 years, the big tech firms, think the Mag 7 type firms, the big tech firms have spent north of $550 billion dollars on AI and utilizing AI and developing products around AI. Now, one of the tricky parts to this is that up to this point, again, numbers that we can find, it's estimated that revenue's been about $35 billion dollars on 550 billion, north of 550 billion spent. So clearly that's not the greatest situation. Now, MIT, the university, recently did a study where they were talking about generative AI and the amount of companies that are investing in it to try to help it, propel their business forward. But according to their estimates, one key number that struck me as interesting is that 95% of companies that are investing in generative AI have yet to see any returns. They're not generating any revenue. It's just all money out the door. Now, with all this in the back of our mind, I do want to point out that we are still relatively early in the AI phase. So if somebody were to argue with me that, well, it's too soon to see the returns, okay, that makes a lot of sense. But now let's just look quickly at some of the similarities. Now, just in case you didn't see the last video I did, well, in the last video I did, I was actually trying to learn more about some of the deals that were happening with OpenAI, the biggest AI player out there, ChatGPT, and kind of the creative financing that they've put in place with many different companies. Now, in the last video, I went a bit more detail. This, I'm just going to give a quick rundown of it just so we can get an idea. And then we're going to roll back to the tech bubble and look at how it compares to that. And then onto the financial crisis. So, the first company to really look at is NVIDIA. NVIDIA is obviously the biggest player in the game, and they have a deal with OpenAI. Now, they've had a deal with OpenAI for a while, but just recently they've updated that deal. Basically, NVIDIA is going to acquire $100 billion worth of OpenAI. But instead of giving them money, what they're going to do is they're going to get chips. So, in the last video I did, some people commented about this being a chips for stock deal. And that's exactly what it is. But it goes one step further than that. So, NVIDIA gets shares of OpenAI, which is, by the way, a private company. And OpenAI gets NVIDIA chips, lots and lots of NVIDIA chips, $100 billion worth of NVIDIA chips. It'll actually be slightly less than that, but still a lot. Now, interestingly, according to the rules of accounting, well, NVIDIA gets to count that money as revenue and ultimately profit. It'll lead down to profit right after they account for the costs of making those chips and all that stuff. But they get to account for that revenue. So keep that in the back of our mind. Okay. Another very similar but kind of unique situation, AMD. Now, AMD is a little bit different here because AMD they're not acquiring any of OpenAI stock. Actually, what AMD did, I think, is funnier, but they gave OpenAI warrants in their company. So a penny a share. So basically, OpenAI will do it. Now, here's the deal. The deal goes something like this. We're AMD. We're going to give OpenAI these warrants. When the market hears about the value of these warrants, about the value of our deal, our stock price is going to go up. You, OpenAI, because you don't have the money really to buy my chips, you, OpenAI, will then have the money to buy the chips and you will buy the chips. Now, in the meantime, we need to we need the chips. So we're going to give you the chips. We're going to do this whole deal. You'll get the warrants down the line. So you'll be able to get financing in the meantime. And we'll sort out this whole thing. But essentially, it kind of is a vendor financing type of deal. OpenAI gave them stock and is also giving them chips, which I just think is funny. But just keep that in the back of our mind. Okay, now we're moving along to something that is not quite as creative as the other two. Those are more creative deals. But this is Oracle. Now, I think Oracle's an interesting one because their deal is a little bit simpler. So OpenAI came out and said, Oracle, we want to use Oracle Cloud Services. And in order to do that, we need you to ramp up your cloud, right? We're going to use Oracle Cloud, which is great for Oracle, have a high profile customer like this. We need you to expand your cloud platform to be able to handle our needs as OpenAI. And this deal, again, I get more into the details in the last video, so I'll leave a link in that description below if you're curious to that video, if you want to see it more nuanced, look at it. But basically, it was a $300 billion deal. Now, what was interesting about that is in order to, let's say, expand their cloud network, the Oracle Cloud, well, Oracle has already gone out and issued $18 billion in debt. Some estimates say that in order for them to start collecting on that $300 billion contract, which is $300 billion, I believe, over 5 years, but it doesn't start until 2027. Well, leading up to that point, Oracle's going to have to lay out, estimates have it somewhere around $100 billion. Now, just so we're clear, Oracle last year, over the past 12 months, put up about $12 billion in profit, which is why they're going to have to figure out ways to come up with this money. They put up about $12 billion. They're going to need about $100 billion. But this all works out very, very well because one, they get a $300 billion contract, but also OpenAI is a massive customer. I mean, they're bringing not only let's say the credibility, but again, they're able to sign this $300 billion deal. Now, this is where it starts to get interesting. And now we start looking at this from, is this above? Now, here's why. OpenAI, again, it's a private company, so we don't really know for sure, but estimates have it in 2025 through October. I found this article through October that says they have an estimated revenue. OpenAI has estimated revenue of about $13 billion. Now, just to remind us, as you can see here on the screen, $13 billion is what they've generated over the past year, give or take. Let's give them credit and call it $15 billion, right? They just signed a $300 billion deal that goes off in 2 years. And this is with one of their smaller vendors. I'm not smaller, but compared to NVIDIA and AMD, they're Oracle's, not the biggest player in the game. And they just signed a $300 billion contract. Now, rolling back to the tech bubble, so the late 90s, early 2000s, well, the exact same type of thing that we just saw was happening all over the place. There was a bunch of vendor financing. They called it, this is an article from the year 2000, put out by Barron's, called Funny Money, where basically they walk through the different types of deals that companies were doing. Basically, vendor financing is when a company like, let's say, AMD gives the customer something. Now, in AMD's case, they gave the customer shares to then use the shares, so the increased value of those shares, to then buy their product. And they're going to do this in the meantime, give them all the product, essentially just give it to them. And what's interesting about that is that what happens if the customers don't pay that way? Now, OpenAI is massive and all of that stuff, but what happens if the customers go out of business? Well, back in the 2000s, all of this stuff started to happen. In fact, if you look at a company like Cisco, which is still around today, but Cisco was doing a lot of this funny money financing. Their name was actually in that article. And here, and then as things started to blow up and different companies started to go under, because all you need is a single kink in the chain to kind of go off the wheels where they can't pay. But these companies already booked the revenue. In fact, if we're looking at a company like Cisco, going back to the tech bubble, well, over on the Investors Grow website, you can zoom into different time periods. And here, this is the late 90s up to the year 2000. And we can see that Cisco was doing very, very well. In fact, Cisco, for a short period of time, became the most valuable company in the world. Somewhere near, I think they had a market cap of about $500 billion at the time. Put up a few $1 billion in profit. This isn't even revenue, this is profit, right? So they were putting up a decent amount of profit, but a lot of it was coming from kind of these funny money deals where they were marking these things down as profit or marking them down as revenue, but they weren't actually collecting the actual cash. Well, according to the rules of accounting, you're allowed to do that. You're allowed to mark that down in revenue. That is what you're supposed to do. But if you don't get paid, or if there's a reason to believe that you don't get paid, you have to write it down. And then if we fast forward just a single year after they accounted for all of this rapid growth, well, now when we look over at their profit, well, profit dropped a drastic amount. They, in fact, went unprofitable. They went from steamrolling the industry, the industry was touting how everything was different this time because the internet was going to change everything. And what's fascinating about this, in my eyes, compared to today's situation with AI, is that the internet did, in fact, change, if not everything, certainly a lot of things. And at that time, Cisco was one of the dominant hardware manufacturers out there. They were one of the key players, and they're still in business. But if we invested in their stock at the high prices that they were trading at leading up to the tech bubble, based off of all that growth and hype, well, this is a chart again on the Investors Grow website going back to the high right near the high in 2000. I did mid-year of 2000, and mid-year of 2000, we can see that up to today, the stock is up, yes, but it took an awful long time to get there. Now, this chart isn't accounting for dividends. They started paying a dividend after the financial crisis again. So that would have returned some capital. But again, it was longer than a decade before we got our money back for an investment in something that actually played out extraordinarily, let's call it accurately. They were predicting at the time that the internet was going to change things. The internet did in time change things, but there was just way too much hype around it. Now, roll back to the current situation, and this is where it really, really starts to get interesting. Okay, so the real question is, how do you make all of this happen? How does all of this growth actually happen? What are they doing with all the money that they're spending and all the deals that they've kind of tied together with each other? Well, in short, the answer is you need more data centers to make all of this work. And this brings us, sadly, to a page right out of the financial crisis playbook. So just to make sure that we're all on the same page, let's roll back to how things worked back in the financial crisis. So we had banks. Now, banks would lend money, and I'm keeping it super simple. They'd lend money to people, families, companies, whoever it was, people that ultimately wanted to buy houses. Now, at the end of the day, those people's family houses, people, family, companies, whatever it was, would have to lend money, would have to pay the bank interest. Now, because banks are, largely fairly greedy creatures, well, they, of course, don't want to just collect those payments. So what if they could, let's call it, package those up and sell them for money now? So they created a product known as collateralized debt obligations. Now, what would happen is the mortgage payments would ultimately go into this package, and they sold those packages off to other investors. Essentially, the credit markets began to fuel the housing bubble. So this cycle could just keep going more and more and more and spin faster and faster out of control. Ultimately, they would lower their standards. The banks would lower their standards so you can create more and more subprime mortgages. Well, since the belief was housing prices would just keep going up, it would go up faster and faster and faster. And there was a never ending need for more houses, faster building, all of that stuff. Well, they just kept doing this cycle over and over and over until eventually it popped. Okay, now fast forward to today and the current, let's call it the AI situation. Well, tell me if you see a similarity between this and what we had in the financial crisis. What do companies need? Well, companies need, in order to make all this happen, as we just saw, they need data centers. So, if they need a data center, well, there's other companies out there that build those data centers. And ultimately, another company will say, we will build that data center. In return, you will give us money for that data center. So maybe it's a lease payment, maybe it's rent, whatever it is, you will give us, let's say, monthly income for that data center. Now, data centers can be expensive. If you look at the NVIDIA deal, the data centers that they've put up, I've seen estimates saying that'll be around $50 billion to build one of those. So the AMD one I heard was going to be in the $35, $40 billion range. So this is big, big money. So you got this company that is building the data centers. Well, how do they build more? Because as we know, this time is different. We need more data centers. One's not enough. We need two, we need three, we need five. We got to keep going. So what do? Well, and this is actually happening. In the past 2 or 3 years, they've really started ramping this up where these companies, these smaller companies, are then doing exactly, take a page right out of the financial crisis playbook. They're taking the rents, the lease payments from the data centers, and they're saying, you know what, let's package those up. Let's be creative here. We're going to call it a collateralized debt obligation, a CDO. Well, that CDO essentially gets converted into a bond. And because they essentially sold a bond on those payments, what do they get? They get a whole bunch of money right now. They take that money, and then that allows them to build the next data center that they have to do. And this cycle just keeps going over and over and over again. It has not popped yet, but I'm telling you, it's almost, play by play what happened with the financial crisis. And to make it even worse, if you look at the big companies, when I was first starting doing the research and saying, well, I hate to say the phrase, this time is different, but this time is a little bit different. The companies are significantly better and bigger today than they were back in the financial crisis. Back in the financial crisis, it was largely individuals that were doing it. The banks, sure, they over-leveraged themselves and all that stuff, but they got a government bailout. Now it's big companies with big, big money behind them. How could they possibly mess this up? Well, we actually have an answer for that. And again, this is an actual situation that's happening right now, and there's lots of them just like it. But let's call this big company here, we're going to call it Meta. And for anybody who doesn't know, Meta owns Facebook. So that's who they are. Now, they need a new data center. And the reports that came out, the instance that I'm referring to, says that they need $29 billion to build this particular data center. Okay, simple enough. Meta has, I think, $40 billion in cash, $20 billion in long-term investments. They got more than enough money to build this. But if you're Meta and you've got companies approaching you with ideas for financing, let's call it creative financing. So instead of you forking over $29 billion, why would you do that when we could set up something known as an SPV, which is a special purpose vehicle? This is a separate company. And this separate company is going to go out and raise money to build the data center. Let's say they're going to raise $26 billion in debt. This is what they actually did. $26 billion in debt, $3 billion in equity. And they'll be able to raise that money because, well, they have a contract with Meta saying that Meta is going to lease this data center from them. Well, what does that mean? That means that, lucky for Meta, they don't have to put up the $30 billion anymore. But here's where the real problem is. Because this is a special purpose vehicle, and the way that it's been structured is that Meta does not have a consolidating interest in the special purpose vehicle, well, they don't have to count that debt. So, as an example, if a company were to buy another company, we were to buy a different company. Well, if we buy just a small piece of that company, if they have debt, that's not our debt. If they have cash, that's not our cash. We can't count any of it. We can count our piece of their profits or perhaps our piece of their loss, but we can't count their debt. That wouldn't be fair. So, what Meta and other companies are doing is saying, you know what? Let's set it up that way. We won't have a consolidating interest in that company. Therefore, that $26 billion doesn't go in our balance sheet. It doesn't affect our credit rating. It does not ultimately show up on our books. By the way, not to compare these two companies, but WorldCom, Enron, those types of companies were big with this type of setup. This is one of the many things that they did illegally, but this is a legal version of kind of hiding things off balance sheet, right? This is off balance sheet financing. But here's the trick. If you're Meta and you have the cash and you have some debt, but you have enough cash to build a data center, what if you need more data centers? What if you don't need one, you don't need two? What if you need 3, 4, 5, 10? What if the number just keeps going up? Well, in theory, you could set all of these up. And at the end of the day, this whole house of cards has the potential of really coming down on itself. Everything from the creative financing around how, hey, let's boost our revenue. I'm going to give you this, but you're going to give me this in return. And we're not really going to change cash. We're not going to really change much cash. $100 billion deal without us ever swapping any cash, but it's going to boost our revenue. It's going to boost our profits. We're doing things like that. Then we're going to off balance sheet financing where, hey, I'm not even going to have to show this debt. And then we need to build more data centers. So you know what? Let's let the credit markets fund the data centers. Now, of course, all of this is 100% going to work because there is an infinite supply, or no, an infinite demand for data centers until there's not. That's the tricky part here. As I was doing my research, frankly, for the last video, I was sitting here looking at it. It was like, oh my God, it's almost like in setting all of this up, we took the, best of all the previous crashes. We took a highlight reel from all the previous crashes and said, let's take a play out of all of them. Let's, use off balance sheet financing. Let's collateralize the income from this thing that we need, need to grow. Let's come up with these special deals with each other to boost up revenue and really keep things going. There's no doubt at some point this whole thing implodes. How does it happen is really yet to be seen. Now, the interesting part about today's situation versus the tech bubble or even the financial crisis of 2008, 2009, is that a lot of the companies involved in this, companies like NVIDIA and Microsoft and Google, well, these are big companies without AI. Before AI, they were big players. They have a lot of cash. They have a lot of cash flow. This just has the possibility of really snapping things away from them. And it really has a possibility of kind of popping the bubble. And suddenly, the prices that we're paying for these stocks today could look fairly outrageous. To illustrate what I mean with all of this, well, when we jump over to the Investors Grow website and we look at a company like Microsoft, well, this is a chart in the fair value section of the website where you can see a historical chart of Microsoft's own PE ratio. This is a quarterly chart going back the past 10 years. And take a peek at the broad trend over the past decade of their PE ratio. Well, clearly, it is in fact trending higher. Now, right now, it happens to be sitting up at, even compared to their own history, 38x is a very high number for even Microsoft. But what I would argue is that a lot of this growth, this trend higher, I think the trend higher makes sense. Companies that tend to trade at a higher PE multiple are companies that are growing faster. Faster growing companies usually trade at a higher multiple. That's just kind of a fact of how it works. But if you were to look out and you were to believe that a company were not going to continue to trade, were not going to continue to grow higher, well, that PE would shrink. So I bring this up from an investing standpoint. I bring up this entire bubble conversation because if we are considering investing in these companies, now I personally own Microsoft. I like Microsoft as a business, but at the current price, it is pricing in such high growth for such a long time. And as we just saw throughout this entire video, it is very possible that that growth is going along beautifully, just like it was with the tech bubble, until one day it's not. And that's where the real problem could be, is that if that happens, this PE ratio is likely to get reset along with almost every company in the industry. And that is the part I want to guard us against, or at least for us to consider when we're doing our research. So if you're digging into a company, look into, are they doing special purpose vehicles? Are they hiding numbers off balance sheet? That doesn't necessarily mean they're uninvestable, but do some digging into how much are they hiding off balance sheet. Right now, the only one I could find on Meta is this $26 billion in debt that they have off balance sheet. But if they do that 10 times to put up 10 different data centers, that's a lot of debt hiding off the books that when you look quickly at their numbers, you're not seeing. That's why it's so important to do a deep dive. Now, with all that being said, let me know your thoughts in the comments below. If you'd like to sign up to get access to this website, I will leave a link right here, link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.